For a lot of people, this might be a difficult read, and so hopefully this video series will be helpful for you as you try to navigate the book. So you might be asking yourself, why should I study this book? And the very first thing that I'll highlight is that Warren Buffett, who's worth over $66 billion, is quoted as saying that this is the best book by far on investing that's ever been written. The author, Benjamin Graham, was actually Buffett's professor at Columbia University. And later, Buffett actually used a book called Security Analysis whenever he was a student under Graham. And then Graham went off to write The Intelligent Investor a few years later. And it's an easier version than Security Analysis, which was about a 600-page textbook. So we're going to be going through The Intelligent Investor here. And at the very start of the book, there's a preface that Warren Buffett has actually written. And in that preface, Buffett talks about 3 primary points that he wants to highlight for the reader. The very first thing that Buffett highlights is that investing does not require a super high IQ. So that's very encouraging for a lot of people out there to know that this billionaire doesn't think that you need to be super smart or have a statistics degree in order to accomplish what he has accomplished. And this book is that foundation. So the next thing that Buffett highlights is that you need to pay attention to chapters 8 and 20, and we'll have a full video on that later on, so we'll discuss that in depth later on. The next thing that he highlights is that for outstanding results, it really comes down to 3 things in the stock market. The first one is your effort that you put forth. The next one is how much research you spend looking into each particular stock pick. And then the third one is how many market swings you actually get the opportunity, and I'd like to say opportunity, to experience. That might be counterintuitive to what a lot of people think, but Buffett actually looks at the drops and the peaks in the market as the times whenever a person can take advantage of huge opportunities in the stock market. So we'll discuss that in a lot more detail as we go through the book. So chapter 1, the book starts off in chapter 1 discussing the difference between speculation and investing. Before anyone can kind of move throughout the book, they've really got to understand why Graham delineates between these 2 different terms. So Graham says that investing promotes the safety of principal at an adequate return. So what does he mean by principal? So if you take an investment and let's say you invest in Microsoft, that $1,000 is what is referred to as your principal. That's what you're initially putting into the investment. And what Graham says is that you shouldn't try to get a 50% return or a 70% return on your money within a short time frame. You should just expect an adequate return, which I think he would consider 10% an adequate return. So that's what Graham refers to as investing. Now, whenever you're speculating, Graham says that you're not doing either one of these things. You're not promoting the safety of your principal, so you're not protecting that $1,000. Or you're not really going after an adequate return. You might be going after an exuberant return of maybe 50 or 70%. So that's the difference. That's how he determines the difference between speculation and investing. So let's go ahead and do an example here. So the next thing that Graham talks about in chapter 1 is the difference between a defensive investor and an aggressive investor. So that defensive investor is looking for that marginal return and that safety of their principal, which you see over here on the left-hand side. The aggressive investor, he's wanting a very large return and he's wanting it to happen very quickly. So the thing that we got to discuss is, of course, everyone wants to have a large return and they want to have that quickly. But the thing that they're not considering is the risk that's associated with each of these types of investors. Okay, so as we look at that, when we look at that defensive investor, in order for him to get his marginal return, there's typically a pretty high probability that they're going to get it. And I know it might seem easy for me to say that, but as you go through more of these lessons and we go chapter by chapter, you're going to see ways and keys to discovering defensive investment where you think you'll get a good return and it's very safe and stable. And then you're going to see ways that you can determine whether something's super aggressive and doesn't have a lot of stability, has a lot of risk, has a lot of debt. We'll show you how to determine that in later chapters. But for right now, just understand that the defensive investor is going after those high probability picks, the ones that he has a lot of expectation that's going to continue to do well into the future. Whereas the aggressive investor, he's looking for that really large return, but he knows he's probably going to only get it a few times out of, call it 10 picks. So as you see on the screen, you see how the arrow is sliding from the defensive investor's pick where there's a marginal return as it slides towards the aggressive investor. You see how your high probability goes into a low probability and that your likelihood of actually selecting a pick that's going to have that large return greatly diminishes. Okay, and so Graham's big point is this right here. As we look at this slide, okay, you can see that the defensive investor let's say he picked 4 different stocks and he invested $1,000, which you can see is the principal there. And let's just say that his return is the returns that we see up there. On the first pick, he had a 5% return. The next one was -2. The next one was 12%. And then he had a 20%, which was a good one. So the return that he actually got back on that are the numbers that you see there associated with each one of those stock picks. So in the end, let's just say that this happened in a year's time frame. His $4,000 turned into $4,350, which was an 8.75% return. Now, as we move down and look at the aggressive investors' picks, he had $1,000 for each stock, and look at the returns that he had. So he was picking the high return, or what he thought was going to be a high return pick, but had very low probability that it was going to occur because the company was so unstable, had maybe some really interesting earnings reports and things like that put the stock pick in this category. So as we look at this, although he might have had a 60% return, which a lot of people would be like, wow, that's a huge return. You look at the other pick, and it also had a negative 60% return. And then the other 2 picks were kind of a wash. So what Graham describes is this aggressive investor would be the type of person would be probably going around and telling all of his friends that, oh yeah, I had a 60% return, but then fails to tell you that he also had a negative 60% return. And so when you look at the values that investment had created for him, although he had some really big returns on some things, he also had a lower return on others, and the amount that he made was not really that much. He only had a 2% return. So Graham's opinion is this, and this kind of concludes the first chapter. Graham's opinion is that the low probability of aggressive picks will actually outweigh the gains collected over a long period of time. And so the aggressive investor will expect to fare better than his passive equivalents, but his results will most likely be worse. And this was Graham's experience, and that's why he wrote this in the book, is to try to demonstrate to people that although the defensive investor might look like he's not really getting ahead because he never has that pick that goes 60% yield, in the long run, the defensive investor is the one who keeps chugging along and actually having better results in the long haul than the aggressive investor. And so let me just reiterate, the difference between investing and speculating, which is what Benjamin Graham teaches in his first chapter, is that investing promotes the safety of the principal at an adequate return, and speculation does neither. I want to highlight a very famous quote by Warren Buffett. Warren Buffett says, "I don't look to jump over 8-foot barriers. I look to just step over 2- and 3-foot barriers." And that quote really comes from the first chapter of The Intelligent Investor, as you can see demonstrated here. So that concludes our summary of the very first chapter of The Intelligent Investor, and we really look forward to seeing you in the second chapter, where we'll go through some more principles.